Credit cards can be an incredible financial tool, or they can completely wreck your finances. It all depends on how you use them. Recently, I uploaded a video where I shared my current credit card stack, and I have quite a few of them. I absolutely love using credit cards. And from a few of the comments, I realized that there are some people that are just getting started with their credit card journey. So today, I'm going to walk you through 9 lessons that every credit card user needs to know in order to avoid debt, build credit, and use your credit cards to your advantage. Welcome back to my channel. My name is Layla and I talk about all things personal finance, and we are going to start with lesson 1, of course. Credit cards are not free money. Now, I know this sounds obvious until you're staring at your credit card statement and you owe $3,000, $5,000, whatever it may be. If you start thinking of your credit card as extra income, then honestly, you're already in trouble. It is not extra income. It is not even your money. You're literally borrowing money from the bank that you have the credit card through. And if you don't pay your credit card in full, you're going to owe interest. Whatever purchases you're charging to that credit card, it could be $1, it could be $5, $10, $2,000, it could easily become so much more because of the interest that will accrue on it. And then your interest accrues interest, and that's where you go down a slippery slope. It's very easy to start swiping left and right because the money is technically there. You know, you could have a $10,000 credit limit, and each time you go to swipe that card, it does get approved because the money is available, but you do have to pay that back. And this is where things can start to get tricky, or people will say things to themselves that justify their purchases. Like, oh, I'm getting paid next week, I'll be able to pay this off, or I'm getting a promotion, I'm getting my tax refund. But then over the next few weeks, something happens, an emergency, or you just fall behind on your bills, and then you have a whole bunch of credit card debt and you don't have the money to pay it back. Number 2, just because you receive pre-approval, you may get an offer in the mail or through email, it does not mean that you need to apply for that card. You may receive one of these offers. It's likely going to be from a bank you've already done business with. Keep in mind, business. We're going to come back to that, right? Because credit card companies are businesses. So these banks that are giving you pre-approval offers do have some history on your credit and your usage of credit. So they are giving you this pre-approval offer and hoping that you will apply, and you may or may not get approved for the card. It just depends. Honestly, it's more likely that you will get approved by getting this pre-approval offer, but you do not need to apply, and it is not a guarantee. So going back to credit card companies being a business, that's exactly what they are. Most of their customers make them money. Most people cannot use credit cards responsibly, so they're charging on their card and paying interest on a monthly basis, and that bank is profiting. So what they're hoping by sending you this pre-approval, you're like, shiny object syndrome. You're like, I need that. I'm going to apply for that. I could get a 6,000 credit limit. I can go on vacation and spend all this money. They want you to act that way. Open this account, go into debt, owe them money, owe them interest. You absolutely can have 10, 15 credit cards if you want to, and if you can use them responsibly. But if you have 1 card, 2 cards, and you're good with that, you're comfortable with that, you don't need to apply to this. And oftentimes you'll get these card offers and they may not be the best for you. If you are looking to open a new card, you may be better off actually choosing one based on your goals and your lifestyle, so where you are spending money. So if you are trying to figure out which card is actually worth getting for you, I highly recommend you check out Forbes Advisor, who is actually the partner of this video. Forbes Advisor has an up-to-date, super organized and helpful list of all of the best credit card options available right now. Whether you're looking for a no annual fee card, highest cash back rewards, travel points, a bonus, they break that all down for you. And up at the top, they have this short and sweet summary of all the best cards. And as you scroll down, you'll get some more information about each of them. So it's super easy to compare cards based on what actually matters to you and your lifestyle. So rewards, fees, intro offers, your credit score, and more. By the way, y'all, do you see the first one on this list, the Chase Sapphire Preferred? The welcome bonus right now, 100,000 points. I know that this is their best bonus ever, and it's going to be the biggest one of the year. And I also know it's not going to last long. So if you're interested in this card or you want to compare cards and see what works best for you, definitely check out Forbes Advisor. The best thing is it's free to use. Check out the first link in my description box and see the best options out there today. Thank you so much to Forbes Advisor for partnering with me for this video. And now let's continue talking about using those credit cards responsibly. Number 3, minimum payments are a trap. The best way, the most responsible way to use a credit card is paying your balance in full every month. Now, you may be in a situation where you have multiple credit cards and you are working on tackling your debt. So some of the cards you may be following the debt avalanche or debt snowball. I have some videos on this. I can link those down below. So you may be using one of those debt payoff methods at the moment. So some of your cards you will be making minimum payments on while focusing on just one of the debts. And that's great. Great strategy. Do that. But that's a little bit different. In general, minimum payments will keep your account in good standing, which is great, but you will be paying interest on the rest of the balance that you owe. And if you even have just a $1,000 balance and your minimum payment is $35 and you only make that minimum payment month over month, that's going to take you years to pay it off. And it's going to cost much more than $1,000 because of the interest tacked on there. On your monthly statements, this is actually something you should be able to see. They will break down. If your balance is X and your minimum payment is this and that's all that you're paying, then it's going to take you X amount of years to pay it down. That number may shock you. It could be like 15, 19 years. It's crazy. If you pay your balance in full every month before the due date, before the statement date, we'll talk about that in just a bit, then you will owe $0 in interest. And that is ideal. This is exactly how you can win with credit cards. You borrow the bank's money temporarily, you get your points, your rewards, and then you pay it off before they charge you for it. Rinse and repeat, and you will just be making money, not losing any money. Number 4, another simple and obvious one, but a huge one. Never miss a payment. Never miss a payment. This makes up the largest portion of your credit score, about 35%. And just one missed payment can tank your credit score dramatically. It's going to be by like 50, 75, 100 points, and it will happen fast. On top of that, that hit to your credit score is going to stay on your report for about 7 years. You're going to be slapped with a late fee. Your interest rate is probably going to go up. It causes the bank to lose trust in you, and that can affect relationships in the long run. It's not worth it. So you may make a late payment, and it could be a couple of days late, but the real trouble is when it goes beyond 30 days. That's when it starts getting reported to the credit bureaus, and that's when you're going to see your score drop. So at the very least, be making those minimum payments. Ideally, you would be paying off the full balance, but the minimum payments are what's going to keep your account in good standing, and you'll be fine. And do what you got to do to make sure you pay that. Set up auto pay, put a reminder in your calendar, make sure you always have enough money in your bank so you can make that payment, so on and so forth, and you'll be fine. Number 5 is to understand your APR, because a lot of people don't. APR stands for annual percentage rate, and it's the interest that you will pay if you carry a balance. Now, there are ways for you to calculate this. You can do it manually if you want to. There are tons of calculators out there on the internet for you to use as well. But on your statement, you should be seeing, if you're carrying a balance, you should be seeing how much you're paying in interest on a monthly basis. And going back to the minimum payments that I was talking about before, you can also see how much it's going to cost you if you only make those minimum payments. And it usually ends up being so much more because of your interest, because of your APR. A lot of credit cards have an APR between a range of, it's a pretty wide range, it can vary. So 15%, I've seen as high as 33%. And obviously the higher, the more it's going to cost you. And it doesn't matter if you don't carry your balance, APR is basically irrelevant. I have no clue what the APRs are on my cards because I don't ever pay interest, and that's where you want to be. But if you're carrying a few $1,000s of a balance every year, year over year, it can cost you hundreds, potentially thousands of dollars in interest alone for nothing. I know I already said this before, but you may have bought a laptop for $1,500 and you paid $1,500 for that laptop, but if you're not paying it off, now you're going to be paying $2,500 for the laptop because of the interest. So if you do have a balance, know your rate and how much it's costing you on a monthly basis, and hopefully that motivates you to pay it down faster because you'll save money. And it's worth mentioning here that it is absolutely worth giving it a shot to call your credit card companies and ask for a lower interest rate. because some of them will do that. If you have been making your payments on time, if they have any current offers, you can just make a phone call, see if they can lower it, even if it's temporarily. They may end up lowering it, and obviously that is great. You'll want to take that offer, and then they may not, and that is okay. You can try again after a few months. If you still have that balance and you want to work on lowering the interest rate, just call again in 6 months or so. Number 6, your credit limit does not equal your spending limit. I know this might be another one that is obvious, but recently I was thinking about when I was a little girl, I was going furniture shopping with my dad, or I like had to because I was younger. And I remember thinking, I actually had asked him, like, how do you pay for this? And he had a $30,000 credit limit. And I remember being so shocked by that, like 30,000, and thinking like that's how much he could spend. Like he could buy $30,000 worth of furniture. So at the time I probably didn't know what a budget was, but I'm thinking like, whoa, he can spend $30,000. That's his budget, you know? And unfortunately, some people may not ever learn that that's not actually your spending limit. Like it does not mean you need to reach that amount. So you may receive a card and your credit limit is $5,000, but that does not mean you go and charge up to $5,000 on there. This gets into credit utilization. So it's actually much better to have a lower credit utilization rate, the percentage of your credit in use. And the higher your credit utilization rate is, the lower your score is going to be. So if you have a $1,000 credit limit and you have $800 charged on that card, that means your credit utilization rate is 80%. But if you got it down to a $100 balance out of that 1,000 limit, now you have a 10% credit utilization rate and your score is going to go up. When you're looking at your credit score, you're going to see the suggested 30% or less of your credit limit. You may even see 10%. Personally, I think it should be 0%. There's also the myth out there that you should carry a small balance. You should have about a 10% credit utilization rate, and that's how you're going to increase your score. That's not true. I have a almost $90,000 credit limit across 11 different cards, and my utilization rate is 0%. It's been at 0% for years, and my score is in the 800s. So again, this goes back to use your credit card, only charge what you know you can pay back, pay off the balance in full every single month, month over month, and don't pay any interest. Your credit utilization at 0% is fine. Your score will be fine. Number 7 is to know your due date and your statement date, because a lot of people know their due date, but they have no clue what the statement date even means or like how that matters. So obviously the due date is when your minimum payment is due, but a few days after your due date is your statement date. If you go log into your bank and you go to your statements, there's typically a date associated with that, and that is your statement date. And that is when your whole statement, everything about that card, is being reported to the credit bureaus. So you could actually be paying your credit cards in full on a monthly basis and making your payments on time, paying it off completely in full and not ever paying any interest. But if you make a charge on your credit card before the statement date, that charge is going to be reported to the credit bureaus, and this is going to increase your credit utilization rate, and it will potentially drop your score. So let me give an example, and hopefully this all makes sense. Let's say you have a credit card with a $10,000 limit. And every month you are charging, it varies maybe. Let's say you charge in 1 month, it's $5,000, but you pay it off. You pay that all off by the due date. But then the day after the due date, so let's say your due date was the 10th of the month, right? So you paid everything off, the whole $5,000, now your balance is down to 0. But then on the 12th of the month, you charge another $5,000. You make a big purchase. And you don't pay that off yet because technically you don't need to. You're not going to pay interest on it as long as you pay it off by the next due date. But since we just passed your due date on the 10th, your statement date is coming up. It's usually a few days later. Let's say for this situation, it's on the 14th of the month. You made that $5,000 purchase on the 12th of the month. You didn't pay any of it down. So now what's getting reported to the credit bureau is a 50% credit utilization rate because you have a $5,000 charge on your $10,000 limit credit card, And even though you didn't pay interest, your score is going to drop because it looks like you're using 50% of your card. So hopefully that makes sense. But basically, if you want a low balance reported to the credit bureaus, then you're going to want to make sure you pay off everything. You know, the ideal situation is paying off everything month over month. But if you do make any new charges, try to avoid making any new charges after the due date before the statement date, because it then could get reported and lower your score, or just make sure you pay those off before the statement date. Number 8, rewards and points from these credit cards are amazing if you're responsible. Y'all already know that I love using credit cards. If I can make a purchase with the credit card, then I will absolutely do so. Every year I make thousands of dollars in credit card rewards or points, and I use that for travel. I use it for just cash back and to pay for things. I absolutely love it. But again, I don't pay any interest on these cards. And what often happens with these cards is people see the rewards options, so they end up spending more money than they actually need to. You may end up buying things that you don't need just so you can get more cash back, and I don't want anyone to fall into that trap. Getting 5% cash back on a $1,000 purchase, for example, isn't worth it if you're not going to pay it down before the interest accrues and you're paying 30% interest. You're losing money on that purchase. Getting 5% cash back on a shopping spree is also not worth it if you didn't plan to make those purchases. Those are things that you don't need. You decide, oh, I'm going to go to the store today and buy $500 worth of clothes that I don't need, that I didn't budget for, so I can get 5% cash back. You did not get 5% cash back, you spent $500. So really, rewards only work if you pay your balance in full and use your card for planned, budgeted expenses. Use your rewards as a bonus, not for a reason to overspend. And finally, we have number 9. Credit is a long game. Building an exceptional credit score, or even rebuilding your credit score to where it once was, is not something that happens overnight. It takes consistency, it takes responsibility, and it takes time. So if there's any companies that start reaching out to you that are like, oh, we can fix your score in 1 month and you'll get it up to the high 700s. No, just do not fall for that. You can build up your credit score naturally on your own. And there's a number of factors that go into it. Your credit age matters. Your on-time payments, those matter. Your utilization rate, the number of hard inquiries that you have on your credit score, all of those things play a role in your credit score. So don't go and open a million credit cards at once. Don't close old credit cards without thinking about it. You may pay them off, but not always recommended to close them. And yeah, in general, and most importantly, build good habits, strong financial habits, and give it some time. And eventually you will get that score that you're looking for. You'll get to good, you'll get to exceptional, and really what this allows, it creates financial opportunities for you. So when you go to get a mortgage or get a new loan, you're going to get lower interest rates. It could be a yes or no for certain jobs. It can help you to lower insurance premiums. So overall, it is a very important thing, but don't try to rush the process. Just be responsible and just give it some time. Let me know if y'all have any questions. I would love to hear which of these 9 things was most helpful for you, or if there is something that you wish you learned about credit cards sooner. Don't forget to check out Forbes Advisor and that limited time offer with the Chase Sapphire Preferred Card. It won't last long, so jump on it if you are interested. Thank you so much for watching. Please give this video a thumbs up, subscribe if you haven't already. It really supports my channel, and I'll see you in my next one.